Welcome back. Time for Ask Annex. As always, you got a question for us, please hit us up on the website, annexwealth.com. Look for the Ask tab. In the studio, Fred Coleman, a wealth manager and a CFP. Hey, Fred.
Hey, Danny.
Matt Morzy is Director of Research, also a CFP. Hello, Matt.
Hey, Danny.
Question 1 on Ask Annex. How sustainable is the post-market rally?
That's a really good question. We certainly saw that big boom that those first few days after the election. Little pullback the second week after that, but altogether, we're still up for since President Trump was reelected, for the weird non-consecutive term structure there. But in terms of what the market's doing and where it's moving, I do think that it is something that could keep going. But I will have a caveat to that at the end, and ultimately, I think the reason why it can is that the market likes certainty. And I think the biggest thing going into that election day is that most pundits were saying, hey, this is going to take a day, 2 days, 3 days. It might even take weeks before we have any idea of what's happening. And for the fact that we that night knew, who it was, that the Senate was going to be for the GOP and the House was probably going to be the GOP, which was confirmed, essentially the next day. Markets love certainty, and we had that. And that was a big risk that was on the table going into the election. So that's one reason. Second part of that is we have the Tax Cuts and Jobs Act that's going to be coming due. And knowing now who's going to be in charge of each of the two chambers plus the presidency is really big in terms of what that process is going to look like. Now, my caveat to can this market keep going and is that rally sustainable is that I think there's going to be a lot of volatility and choppiness through that process. Granted, the Republicans are going to control all parts of that process, but the margins are very, very narrow. And especially after some of the appointments that came out of the House afterwards, that makes those margins even more narrow and could take 30, 60, 90 days before some of those seats get filled. There's little room for error there. And as we've seen in the past, in the Senate most recently, that when the Dems had control and Manchin was kind of that squeaky wheel that was able to kind of put that stop sign up at different times and be able to negotiate and get the stuff he wants in. Republicans are going to have that. 100% in the Senate. It's much larger in the House. There's a lot more people that could all of a sudden raise their hand and go, hey, the only way I'm doing this is if I get this for my area. And I think that could create some volatility there. But altogether, yeah, I think it's a positive for the markets. The markets are reacting that way.
Volatility isn't necessarily a bad thing, is it?
No, it's an opportunity. And it really is, because those days that we get a pretty big drop because some report comes out that it's not going to get passed or it's going to get delayed, or if it starts to look like that's going to be more and it could be a 5% or 10% pullback along the way, which I'm not saying is going to happen for sure, but that is an opportunity to reposition the portfolio, take optionality into that market.
Question 2 on Ask Annex. My father-in-law is showing signs of early mental decline. He's 62. We're not sure what course to pursue. He's open to my husband and I assisting and arranging his planning. He is a widow. What are our first steps?
That's tough when a loved one is going through a mental decline, and it can happen to anyone at any time. That's something to keep in mind. But typically, in your 50s and 60s, you should start to think about having some documents in place just to ensure that if you do potentially have some type of mental decline, your finances are protected. And if you have a family history of potential, mental declines, maybe even earlier, you should start thinking about those things. The first document that I would think about is a financial power of attorney. That's going to be a legal document that allows an agent of your choice to manage your financial affairs. So paying bills, managing your bank accounts, doing your tax returns, and other financial decisions. Also, one of the things you want to do when some of your loved ones start to have declines, just to make things easier and more simpler, are things like, hey, let's get rid of any type of unnecessary cards that you may have. Let's put your bills on automatic pay. That way you don't have to worry about, manually paying them each month. And then last, but also a very important step, is establishing a relationship with a trusted financial advisor or wealth manager that understands these types of situations, because it's going to be hard on that person. It's also going to be hard on you. And this is something that, we do offer at Annex. Our estate planning is not only looking at what happens when you pass away, but also reviewing those documents just to ensure that when these types of situations do come up, you're well prepared.
And as an advisor, you'd probably suggest a healthcare power of attorney as well, right?
Of course. So a durable power of attorney, which includes healthcare, financial power of attorney, and then also other estate documents.
I like this. Why is Warren Buffett selling so much stock?
Yeah, we certainly get more questions about him than anybody else from an investment standpoint. And there's a couple of things I think we have to remember with that is that he manages very differently than any other person possibly can, right? And so it's not like it's an individual, portfolio just for himself or something like that more of a retail investor would have. So he has a different mindset when it comes to it, but he is very valuation, centric. So when the market is highly valued, he is going to raise more cash and trim off positions or reduce sizing if he believes that they are too highly priced and he'd rather have something that's more attractive. So he does look for those things. He actually just, recently initiated a position into Domino's. He does look to find some companies that he believes are growing and are not as, expensive, like I said. Other things, is he looks to buy full businesses or increase large stakes within companies as well, too, which is a much different, way to invest than even a mutual fund manager would be doing or an ETF manager. So it just has a different feel to it. And with interest rates still being very high with that large cash balance he still invests in treasuries and things like that and gets a pretty attractive yield. So in his mind, I think he's setting himself and the firm up for success.
Matt Morzy, Director of Research, CFP, thanks.
Thank you.
Fred Coleman, Wealth Manager, CFP, thank you.
Thank you, Danny.